Hey guys, this is Mr. Oxy coming at you live from Palm Beach in Florida. It is Friday evening. It is April the 22nd. It's been a brutal week. Usually, when we have these ups and downs, I kind of sometimes say tongue-in-cheek, one Maserati, two Maseratis. I basically already said it, but I'm not going to do that today. It's been a tough week, and I think we've all kind of seen our portfolios. Especially if you're long in pretty much anything because everything went down. Take a deep dive today. In fact, we know now after the fact and after the market closed today that this was actually the worst day that the Dow has experienced since October of 2020. Now, there was a time during 2020 when moves of like 1,000 points up or down, mostly down, during 2020 was quite common. But since then, it's actually been quite uncommon. And of course, one gets sort of in a mindset where you think, the environment that you're operating in is mostly bullish, and most of the time we see stocks go up. So what I thought I would do is I just took a few screenshots, and I'm going to share with you some of the holdings in my account. By the way, they are on YouTube, in YouTube Studio. There are comments from some of the people in our community that I actually had not seen before until today, and comments that perhaps would have responded to. But YouTube has some filters, and when you guys make comments, and I'm just sharing with you so that you know, but when you make comments about contentious issues like Russia and the Ukraine and the vaccine and the efficacy of the vaccine and things like that, which by the way includes me too. Many of those things get filtered and held back, and then sometimes I get the opportunity to approve the posting, unless YouTube pretty much just automatically deletes it. But anyway, that's just a little bit of housekeeping, just to kind of let you guys know how it works. Take a look here at my portfolio. These are 21 positions that I hold in my portfolio. So one of the first things that the reason why I'm doing this is to show you that there's some level of risk mitigation in diversification. Now, of course, when the entire market goes down and almost enters correction territory in 1 week, it doesn't matter what you hold because there's no risk mitigation in diversification, specifically when everything pretty much just goes down. There are also other ways that you can hedge your positions, and there are a number of things that you can do in order to provide you with some level of protection. One of those is, for instance, to make sure you always have some cash on hand. So you have some dry powder in case some stocks pull back sharply, as they did, which allows you an opportunity to buy, as I did. And I'm going to tell you, as I go through the presentation, I made some sales, and I, in other words, exited some positions, but I also did some buying this week, including of Occidental Petroleum. Anyway, this pie chart here basically shows you the largest positions in my account. Now, to be fair, the majority of these positions, so AllianceBernstein at the top of the pie chart there, and then just to the right of that is Sun Life Financial, below that TD Bank. These are financial stocks, the bank stocks or financial services type companies. And then energy, Enbridge, Oxy, Energy Transfer, Pembina Pipelines trades in the United States as PBA, and in Canada as PPL. And then Icahn is an industrial conglomerate. Icahn obviously owns a number of different industries. Icahn is almost like a broad market ETF, if you want to view it that way, but it pays a very, very big dividend. So let's take a dive into some of these, and we'll take a look at some of these stocks, and I'll tell you some of the things that I did or did not do. I didn't change any of my positions in the financial sector in a material way, although I did add to my positions in AllianceBernstein in a couple of my accounts. TD is by far my largest holding, and that's not necessarily by design. It's more of the result of having been in the position for many years and reinvesting dividends. TD pays me a dividend of about 3.5–4% on an annualized basis. The reason why I keep these stocks, they are foundational to me or for me, is because AllianceBernstein pays me a dividend of about 6% or more. TD is close to 4%. Sun Life Financial, which is a life insurance company out of headquartered in Canada, in Toronto, also dividend around 4%. Bank of Nova Scotia or Scotiabank, Canadian bank, also pays a dividend of around 4%. And Wells Fargo, this little slice here at the bottom, is actually a position I've been building because I managed to pick up some Wells Fargo when it was trading at around $20. And now that it's trading in the 40s, the position looks good, but I think Wells Fargo is still relatively cheap in terms of where we are today in terms of bank stocks. And I expect that over time, the financial sector will recover because it's been on a huge pullback along with most other stocks. I also hold a position which I just generally refer to as other. It is quite a large portion of my portfolio and consists of mainly 4 stocks. So Icahn is probably familiar to most of you. BCE is Bell. Bell is a technology company and telecommunications company out of Canada. SPY is an index of mostly technology stocks. And VYM is a broad spectrum ETF. I'm going to give you a little bit more information on these ETFs in just a second, because I want to tell you also why I am invested in them. Now, a couple of positions that I exited this week includes Sibanye-Stillwater mine. So I took some profit there and cashed out. And I no longer have a position in Stillwater Sibanye or Sibanye-Stillwater. I also cashed out of a REIT, which is AG&C, in my personal account and on behalf of all my clients. And we no longer hold AG&C. One of the reasons why I have been long AG&C for many, many years is because its dividend is close to 12% currently. But anyway, even during the last couple of years when it sort of has been holding the status quo and not going anywhere, the dividend remained at around 11% and they didn't cut it. So I kept kind of socking away the dividend in a DRIP, a dividend reinvestment program. But now I've exited the position because I don't see it going anywhere at all. And I've lost faith in AG&C. I have this uranium basket. I have discussed this with you guys before. So the people who've been following me will know that I hold 5 uranium stocks. Arguably, Energy Fuels, UUUU, is not necessarily a pure uranium play because they also do rare earth and other type of minerals. Paladin is an Australian uranium miner. Govex is a Montreal-based Canada uranium miner. Denison is a Canadian miner in Saskatchewan. And CCJ, for people on the New York Stock Exchange, or CCO for people on the Canadian Stock Exchange, is Cameco. And you can see Cameco represents nearly half of my entire uranium portfolio. I'll say this here, just for the sake of transparency, as a disclaimer, in Govex, Paladin, and Energy Fuels, I'm basically playing with the house's money. I have withdrawn my entire initial investment off the table. And all 3 of these stocks, despite the recent pullback in uranium stocks, have been performing quite nicely. The best performer by far is Paladin, where I'm up about 150%. The worst performer, I think, is Govex, where I'm up only about 20% or so on the house's money. Cameco has been good to me. My cost base is around 20 Canadian dollars. So that's approximately 16.50, 17 US dollars. Currently, Cameco, even after the pullback, is trading at about $35. So I have a strong position in Cameco, and I can basically just hold it in terms of where I am right now. Denison goes up and down like a bride's nightie, and we'll have to see where it goes. But I think Denison has the potential to make some money in the longer term. But these positions are not material to me, with the exception of Cameco. They're relatively small, or the house's money. But here's the other large chunk of my portfolio. Now, I have described it before as sort of a 50-50 type scenario where my financials and my energy stocks are kind of 50-50. But as I just shared with you a minute ago, I also hold other stocks, which include ETFs and Icahn and so on. And let's call that 20% of my portfolio. And then the rest, the remainder, which is 80%, is kind of split 50-50, which would now be 40-40 between energy and financials. So just to clarify, in case you lost my math there, 40% financials, approximately, 40% energy, approximately, and 20% other, which is mostly now Icahn and ETFs. Now, on Oxy, you can see on this pie chart slice here, this is my largest energy holding. However, a couple of them have been creeping up as I've been building the positions, especially Energy Transfer. Now, for those of you who've been following me for a while, you'll know that Energy Transfer is relatively new to me, because the first time I actually opened a position in Energy Transfer, based on a recommendation by Bulldogs #1, was last year. And I think it was maybe at the beginning in Q1 of 2021 that I opened that position. Since then, I have been buying Energy Transfer It pays a nice dividend, and for an old guy like me, dividends are a hedge. And in addition to that, my cost basis is low because I got into Energy Transfer when the price was around $6, $7. I think my average cost basis now is only about $8 or something, and Energy Transfer is trading at around $11. The other two big ones I have is Pembina. It's a pipeline. So Energy Transfer and Pembina are similar. Enbridge, which is a Canadian integrated oil and gas company, also is the utility that supplies natural gas to Ontario, which is Canada's most populous province. So Enbridge has a built-in hedge from the point of view that it gets recurring revenue because it sells gas for heating and cooling to Canadians in Ontario, which represents close to almost half of the Canadian population. XLE is a relatively new position for me. This is the ETF. I'm going to talk more about that one in just a second. And PBR is Ptrobras, and I've also been building this position over time, and I have a nice chunk of shares of Petrobras. My current holdings in Occidental, off the top of my head, is about 4,500 shares. There have been people on my channel who said I'm no longer bullish on Oxy, and that's fair. I take any criticism or comments as they come. The reverse is actually true. Not only am I holding long and strong, but just this past week, I actually added to my Occidental position, picked up another 500 shares in one of my IRA accounts. An IRA is a retirement account in the United States where I can defer taxes until I actually make a withdrawal sometime in the future. Lukoil, L-U-K-O-Y, is Lukoil from Russia. This one is in a holding pattern right now because I can't trade it, I can't sell it, I can't buy more. It's sitting at $6.96. If I could buy more, I would, just to reduce my cost basis. Of course, I cannot trade Russian stocks. I have no comment on that, and I cannot comment on the Russian-Ukrainian situation because I don't have the knowledge to give you good information. Let's take a look at these three ETFs quickly, and then I'm going to wrap it up. So one of the reasons why I hold SPY is because you would have noticed in my portfolio, I have literally no technology stocks. Now, I'm not keen on technology stocks right now, and as you will probably know if you hold technology stocks, they have been crushed over the last year or so. So by holding SPY, I actually have a small position in predominantly Apple, Microsoft, and Amazon, and very, very small positions in some of the other tech stocks. And this represents my entire tech holding. So for each of those large energy stocks, like Occidental or Pembina or Enbridge or Energy Transfer, in equal weighting or value, I hold SPY. So SPY is sort of equal to one of those. You can see the different weightings for SPY, and right at the bottom of the screen says 25% technology, but it still holds 13% in financial services and a little bit of energy, but it's actually quite diversified in terms of a holding. And by the way, if you're a young guy and you don't know what to buy and you want to mitigate the risk of buying single stocks, buy yourself an ETF like SPY. I'm not saying SPY is the best one, but you can buy something like SPY and just hold it. If you can hold it for 20, 30 years, you will do fantastically well. The administrator for SPY, which is a SPDR, so an S&P ETF, is State Street. Vanguard, here's another one of those that you can almost buy. If you're a young guy, you can buy Vanguard's VYM, stick it under your pillow. It relates to in the olden days when we still used to get a share certificate. So it'd be tough to put your laptop under your pillow. But you can buy Vanguard, you can buy something like VYM. It's a very, very diverse ETF. The fees are super low. It's like really cheap to hold. It pays a dividend as well. So not too bad. But you can sort of see the heavy weighting here is in financials and energy, almost 30% of VYM. And then healthcare, industrials, and consumer staples make up a large chunk of it as well. So if you add these together, sort of 10, 30, 40, 50, 60, almost 60% of it is consumer staples, energy, financials, healthcare, and industrials. And ironically, two of the direct energy stocks that I do not hold, Exxon and Chevron, are well represented in VYM because those two together are their fourth and fifth largest holdings in the VYM portfolio. The other one I hold is XLE. Now, this one's easy because it's basically 100% energy. And you can see in this XLE position I hold, because almost half of XLE is Exxon and Chevron, I hold Exxon and Chevron as well. So when I look at my energy portfolio and show you my pie chart of the energy stocks that I hold, I actually have additional holdings in Exxon and Chevron. The only difference is I don't hold it directly. I hold it through a couple of ETFs. I have no qualms about holding an ETF. It provides me with risk mitigation. These ETFs, including XLE, pays a nice dividend as well. I think XLE's dividend currently is about 3.5%. And you can see that XLE even holds a position of 3% in Occidental Petroleum in its top 10. This is a good performing ETF. So once again, especially for young guys, if you are nervous, and you should be, to buy single stocks, especially if you don't do your due diligence and make sure that you understand what you're getting into, a safe way or a safer way for you to approach it is to say, I'm going to buy some ETFs and I'm kind of literally going to just buy it, put it in a lockbox, forget about it, make contributions from time to time, put the dividends into a DRIP, a dividend reinvestment program. So every time you get a dividend, you just buy more stock. You can do a whole variety of different things in order to help you mitigate risk. The other thing that I do to mitigate risk is also hold cash. And earlier on in the video, I mentioned that I had exited a couple of positions, including AGNC, which is a REIT, and Sibanye-Stillwater, which is a gold mine out of South Africa. Now, I did make a couple of sales. Also did quite a few buys this week, including, as I mentioned, picking up another 500 shares of Occidental Petroleum to add to my portfolio, so to add to my existing position. But the other thing that I do is I also hold cash. And right now, the majority of my accounts, as a result of those exits on AGNC and Sibanye-Stillwater, actually holds more cash than what I usually do. So right now, I have a lot of dry powder, which is basically better known as cash awaiting investment, right? Any cash that you hold should always be viewed as cash awaiting investment because cash just loses money. So, but right now, I'm actually kind of cash flush, and I cannot possibly, and neither can you, time the market in trying to find the bottom so that you can sort of pick up the stock at its all-time low. That would be really, really tough to do. But at the same time, I think it's possible that maybe today we've turned a corner. There's a little bit more clarity on the Fed now, potentially looking at 50 basis points on their next rate hike. I'm not sure that that in itself is necessarily material, but there's a lot of stuff going on, including global conflicts and resurgence of the pandemic in certain areas like Shanghai. So there are many, many things going on. Anyway, guys, this is sort of a wrap on this video. As usual, if you like my videos, please subscribe. And at the same time, I look forward to your comments. I shared a lot of information with you, and I thought, based on primarily the comments that I didn't actually even know were in the YouTube account because YouTube had filtered them, and I found them today. And then when I looked at them, I saw a whole variety of different comments, including people saying, you're not bullish on Occidental anymore. You've probably sold out of your position. I have not. I'm long and strong. I have explained that in detail before. I have several thousand shares of Oxy, and I just bought another 500 this past week. There's no reason for me not to be invested in energy right now. Regardless of all the things that the administration have done, we still have oil, and specifically WTI crude, at around $100 a barrel. The oil companies, especially companies like Occidental Petroleum, are still printing money. They're going to have a phenomenal first quarter, and they're going to have free cash flow that is off the charts. In fact, it will probably break the record, which they broke the previous quarter in terms of free cash flow. They can pay down a lot of debt. They can do balance sheet repair in that regard as well. They no longer are under pressure to sell off assets, so they can manage their debt. They're making a lot of cash. They're going to have a good quarter. It's going to be profitable. So on that note, this is Mr. Oxy saying, hang on, hold on tight, right? There are three things you can do when the market crashes. You can either sell and lose a lot of money, or otherwise you can buy a little bit more, which is dangerous, because you don't know where the bottom is. But, you can always nibble just a little bit, kind of like my example of, buying a few hundred shares of Occidental. That represents less than 10% of my position in Oxy, so I'm kind of just nibbling sort of on the fringe. Or otherwise, you can do nothing. Doing nothing is also a strategy. You can also protect your gains. So when you have market pullbacks like this, there are things that you can do. Instead of just holding the stock and hoping everything goes well, you can plug in a trailing stop, for instance, stop loss orders, etc. So there are things that you can do to mitigate your risk. I wouldn't stress too much. It's probably just another correction, and then we're done. So on that note, this is Mr. Oxy saying goodbye for now. I'll talk to you soon. Bye.